Okay, so what is the solution? What do you do if you already have money inside of a taxable account? Over the last few lessons, we've learned the impact of what that looks like on your money. So what do you do about it? Well, maybe you have some money in a brokerage account, maybe you have some money in a CD at the bank or in just savings, and you'd like to do something else with that where it could be tax favored or have a little bit better tax treatment. Maybe it can grow tax deferred or anything but be inside that taxable account. What are your options to do with a taxable account? Well, there's three options. The first option is to do nothing. That's what we would call an increased tax liability. In other words, you're compounding the problem. So if you leave money inside of a taxable account, and it grows, so do the taxes and the opportunity cost and everything else. We've looked at that in previous lessons. The second option is to pay a level or flat tax, meaning that you could take the gains on the money every year and do something else with it so that your tax liability stays the same every year. It doesn't increase or compound. You're just leveling it out and then redirecting those funds somewhere else where there's a tax favored benefit to the money. And then the third thing is a systematic tax reduction, meaning that you're actually systematically over time taking the account that's in this taxable account over here and systematically moving it over into a tax favored account over here. So that's, kind of the options. And how fast do you move it over here? We'll look at that. I mean, you could move it with the stroke of a pen. You can move it in year one, or maybe you want to do it over 10 years or something like that. And that's what we'll look at. Now, just as a note, the following illustration is intended to show the performance of compounding interest in a taxable account compared to a tax favored account. Also, this illustration is hypothetical and not intended to serve as a projection or prediction of investment results. And finally, this illustration does not represent any specific product or investment and does not factor investment costs. If it did, results would be less. Also, once again, I'm not giving you tax advice. Consult with a CPA for any specifics. Now remember, you also have access to our calendar if you would like to discuss any of these topics and discuss some of your specific situations. Because like I said here, we're not going to dive into specific products. We're just going to be talking about the concept because products and everything is very specific to your situation and there's a lot to consider. All right, so let's dive into it. All right, so in this example, we're going to use the following information. We're going to use a 50-year-old and we're going to look at it over a 20-year window. We're not really accumulating money. We're just going to take $500,000 and look at it over a 20-year window at a 5% rate of return on all of these accounts, meaning maybe it's currently earning 5% where it's at. Maybe it's in bonds or something like that, earning 5%. And we're going to move it somewhere where it could also be earning 5%, which means that we've also got an opportunity cost of 5%, meaning that if there is this place over here that you could be earning 5%, but you're going to leave it over here and pay all those taxes could have been earning 5%. That's the opportunity cost. So just to keep it simple, we're going to leave rate of return alone and just do 5% across the board. To be honest with you, whatever rate of return you're earning doesn't really matter. What we're going to focus on is the actual tax implications of it. And then finally, we're going to say that you're in a 30% tax bracket now and a 30% tax bracket later. Once again, just to keep things simple, okay? So in previous lessons, we've looked at just the basics of compounding interest. Here we have this $500,000, not taking into consideration taxes at all. Remember, the idea is that your money, just in our minds, we think of compounding interest as just this nice little graph that goes straight up. And that's what we're looking at here. We have $500,000 and the investment account, of course, is going to grow each year. So year one, it's already growing, and eventually that money over a 20-year window, since we're looking at a 20-year window in this example, that's eventually going to grow to $1,326,649. All right, so $1.3 million is what your $500,000 is going to grow to with just simple compounding interest, not taking into taxes or not taking into consideration taxes, fees, or anything else like that, or impact of losses and all that stuff, which we've talked about in previous lessons. So just basic compounding interest, $500,000 over 20 years at 5% interest would grow to $1.3 million. Okay, so when you're growing money inside of a taxable account, yes, the account is growing like we saw on that last screen, but so is the problem, or in other words, so are the taxes that you're going to be paying. Those are also compounding along with it. On the next screen, we will illustrate not only the growth on the money, but the increased tax liability each year and the burden of that opportunity cost on top of that. So let's dive into that. Here we have our $500,000. And once again, if we just cruise along and we look at this over the next 20 years, we are seeing this tax liability, right? Our $500,000 is growing to $775,000, but we are paying taxes each year. So just this year alone, we're paying $11,000 in taxes. Now this is assuming paying this out of your lifestyle, okay? So we've looked at a couple of different options, but just assuming that you're paying this out of your lifestyle, right? Total taxes paid over the first 10 years is $94,000. And we've looked at this before, okay, you get the idea here that your $500,000 could grow to $1.3 million like we talked about earlier, but you're paying these annual taxes a total of $247,000 over 20 years. But remember, that's not all. That's not the worst of it, because we have this lost opportunity cost on the taxes paid. In other words, that money that you're paying in taxes could have been earning 5% in this example, right? So if we take and look over the next 20 years again, and we see what's happening this time over the first 10 years, we see that yes, we've paid these $94,000 in taxes, but that money could have been earning interest, right? The annual opportunity cost for just that year is $4,900 for a total of $22,000 so far in lost opportunity cost, right? Okay, so as we continue and go to the full 20 years, then yes, we do have our $1.3 million, but we've paid out of our lifestyle, we've paid $247,000 in taxes out of our lifestyle, right? Which could have been earning interest for a total of $131,000 of interest that we could have earned. So if we take the $247,000 plus the interest that we could have earned, and we subtract that from the $1.3 million, the reality of it is that the net is more like $947,000, right? Because it's not really $1.3 million. We've got to factor in the money that we paid out of our pocket for taxes all those years, and we've got to factor in what that money could have earned all those years. Remember, just a quick review of what's happening inside of the taxable account. Okay, so out of our three options, option number one, which was increasing the tax liability, is obviously not a very good option. It's compounding the problem, as we just saw. So that leaves us two options left. The first option is the flat tax alternative, which is where we're going to move the earnings only. Okay, so our $500,000 is going to stay $500,000, and whatever interest that it earns, we're going to take those earnings and we're going to move those somewhere else into maybe a tax-favored position where we don't compound the problem. Our second option that we're going to look at is the reducing tax alternative, which is where we're going to actually move principal and interest either immediately with the stroke of a pen over 1 year, or we're going to do it over a period of years, so that we're going to eventually have all of our money from our taxable account over into a tax-favored position. All right, so let's look at the flat tax alternative. To fully understand the value of the flat tax strategy, the accumulated value of the withdrawn interest must be added back to the original principal. Okay, and in our illustration, we are assuming the interest from the original investment, which is account number one, is invested in a tax-favored account, which is account number two, and you'll notice that the taxes are constant or flat. All right, so here we have our taxable account. This is our $500,000 that we've been talking about. And then we have our taxes on this account. Right? That is our 30% in this particular case. Now remember, we still have our opportunity cost, right? So this little chunk right here is the money that we are still losing in what it could have earned, right? Our lost opportunity cost. But we're going to be taking the earnings on this account and we're going to be moving them over into account number two, which is going to be our tax favored account. So let's just take a look at this first of all, where we take our money, our $500,000, and we're going to go all the way down to where we only have $500,000 left in this account. The account didn't change because what did we do? We flattened it, right? We took the earnings and we're going to move it, okay? But we still have some taxes every year, all right? And those taxes are still, we still have the lost opportunity cost on those taxes, okay? Because those dollars could have been used to earn 5% somewhere else if they didn't go towards taxes. So we minimized our tax liability. We didn't compound it, but we still had to pay taxes. Taxes still could have been invested. So we have our lost opportunity costs. We have our $142,000 of taxes paid. We have our lost opportunity cost of $93,000 for a net of $985,000. Okay, so now let's take a closer look at this account number 2 and where that money was going. So at first, we're going to look at a tax deferred example where we're not going into an account where it's completely tax-free. We're just not having to pay annual taxes. So that money is going to be earning interest, right? But we are deferring it until later, right? So in this example, let's go ahead and go through the years of 1 through 20 years. You can see what's happening down here in year 10. Let's take a look at what's happening in year 10. Our compounding interest, remember, we're flattening that. So we're taking all of the earnings and we're moving it over into account number 2. So account number 2 is earning 5%, but it's earning 5% in a tax deferred basis, right? So we're not paying taxes. So we're minimizing our taxes. As you can see, annual taxes paid, 0. Taxes paid up to this point, 0. We haven't paid any taxes yet. We're not paying taxes as we go, so we're not compounding the problem, right? So as you can see, we've now got these 2 accounts. So what's our final result when we get all the way down here to the end? Well, in this particular case, we still have our $500,000 over here, but now we have a net of $985,000, right? Because we have this account over here that has grown to $826,000. So we have $500,000 over here, $826,000 in this account. Now we have our taxes paid in this one. We have our lost opportunity cost on those taxes paid. And then we have our tax deferred taxes over here. So we have $105,000 of taxes that we've deferred, but we haven't had to pay taxes as we go, so we don't have that lost opportunity cost on those taxes paid. If we look at what is the net result, well, the net result is that with our flattened strategy, where we're not compounding the problem, our flattened strategy, we have $985,000, right, with total taxes paid of $142,000. Now, if we look at our compounding interest strategy, which is compounding the problem, we only had $947,000 and $247,000 in taxes paid. A difference in your pocket of $37,000, right? And $105,000 less in taxes paid. So if you think about it, this is one of those major holes in your bucket that could be fixed, and you could do that by moving just the earnings on your account into a tax deferred vehicle, right? Now, let's look at the tax favored vehicle. Now, a tax favored vehicle means that you're moving it into an account that is not going to be taxed in the future. So we're not deferring the taxes. It's just going to grow tax-free or tax-favored, right? So we still have the same situation over here on the left. If I reverse and go up to the top, you can see what's happening here is that we're still taking the earnings from over here and we're moving it over into this tax-favored position. So we have no taxes being paid on an annual basis, and we haven't paid any taxes thus far because it is a tax-favored account, which means our future tax liability is still 0. So now, if we continue down to the full 20 years, we can see that over time, our $500,000 is still $500,000. We still paid taxes and had that lost opportunity cost on that money, but we moved those earnings over here now into a tax-favored vehicle, which has now grown to an ending balance of $826,000 plus our $500,000 over here, right? Now we're at $1 million net. So that's obviously better than our tax deferred situation. In fact, if we click on that, in our flattened strategy going into a tax favored vehicle, we're sitting at over $1 million now. All right. Now, if we go back to our compounding interest scenario where we're compounding the problem, it would have been at a $947,000 net, right? So that's $142,000 difference in that particular example over just those 20 years and $105,000 less in taxes paid. So as you can see, if we just flattened the tax, we make a huge improvement. Okay, now let's look at the third and final scenario, which is reducing the tax alternative option here. So instead of just flattening the situation, let's actually reduce the tax situation and see how that improves things. In the reducing tax alternative, as the principal declines to zero, the amount of earnings in this account and the taxes paid on those earnings decline proportionately. The next screen shows the withdrawal of interest and principal from the original account, which is our account number 1. And this amount is reinvested in a tax favorable account, which is our account number 2. And the balance or the sum of that account 1 and 2 is also going to be shown. Okay, so in this example, we're going to reduce the problem by reducing the $500,000 in our taxable account. We're going to reduce it over 20 years to start with to see what that looks like and see how that improves our situation by improving our lost opportunity cost and all the taxes on that account, right? So let's go ahead and look down here at what's happening as we go. We'll go down to year 10 and take a look at that. So now our ending of year balance is at $309,000. So we've been reducing that $500,000 account. Our annual taxes is at $4,000. We've paid so far $57,000 in taxes. So our lost opportunity cost on that tax is $16,000. So we're starting to minimize the problem by moving everything over into this tax deferred account. Now our tax deferred account is also compounding interest at 5%. And that money has grown to $504,000 so far. And we've postponed or we've deferred some taxes of $36,000, but we don't have to pay those taxes on an annual basis, right? So we've picked up some savings there. Now let's go ahead and continue down and look at the next 10 years as the money grows. And down here, our account is zero, right? So we've reduced that $500,000 down to zero. We've really reduced our taxes and our lost opportunity costs on those taxes. And our balance over here is $1.3 million in this account number 2, where we've moved the money into a tax deferred position this time, and our savings of $168,000. If we look at what our net results are, let's open up that, and we can see that by reducing the problem, we now have over $1 million versus the $947,000 in our compounding interest example, and which of course compounds the problem, which is a $60,000 difference, and we've saved over $168,000 in taxes. Okay, pretty remarkable in this example because we've done it kind of gradually over the 20 years, right? But what if we did it over 10 years, let's say, or even let's do 5 years. Let's say that we reduce this over a 5-year window. Now what does that look like? Well, over a 5-year window, what are we doing? We're quickly getting rid of the problem over 5 years, which is really reducing the amount of lost opportunity cost and taxes and everything else, and really improving our balance over here on this account. In fact, if we look at these results, now because we did it over such a short period of time, we're looking at a $100,000 difference between those two examples with $233,000 in tax savings. That was money that you would have been paying out of your pocket. So this is a huge, huge improvement to your current situation, right? All right, now let's take a look at what happens when we look at this over let's go back to our 20-year window, all right, and start over. But this time we're moving it over into a tax favored position, meaning we're not deferring the taxes, we're actually putting it into a tax-free vehicle. So if we look at this over a 20-year window, our first 10 years, we can see, once again, our balance is going down, taxes being reduced, lost opportunity cost being reduced, and we have our balance over here of $504,000. But most importantly, this is the key, right? Most importantly, we have not deferred the taxes, but we just are in a tax favored position now, so we don't have to pay those taxes, right? So now if we continue to move all the way down, we can see that end result, $1.1 million. If we click on that to see how that breaks down, we can see that we have saved $229,000. There's a huge difference there between those two. And we've saved $168,000 in taxes over, just compounding the problem inside of a taxable account. So huge improvement in this example. Okay, so what is the net result of all of this? Like, what is the summary of what we've learned as we talk about all these different analogies and scenarios? Well, in this example, we're talking about a tax deferred situation. So not the tax favored, but the tax deferred situation. We first have our balance of accounts number 1 and 2. Remember, it's still $1.3 million. All right, in all of these examples, our net result in accounts number 1 and 2 would be $1.3 million. However, what kind of holes in our bucket did we have during that time? And what was the opportunity cost and taxes paid? Well, taxes paid from lifestyle being the key. This has been money coming out of your pocket every year to pay taxes. On the increasing tax situation where we're compounding the problem, we're talking about $247,000 over 20 years. In the flat tax, where we flatten and we take just the earnings and move it over into a tax deferred account, we're talking about $142,000 in taxes. In a immediate pay down, meaning with the stroke of a pen, we move the money from a taxable account to a tax deferred account, we are talking about $0 paid out of your lifestyle, right, in taxes. And then if we reduce it over 20 years, meaning if we take the money and over 20 years we reduce the account by moving it over into account number 2, we're looking at $79,000. Okay? How about opportunity cost of those taxes? Same kind of an idea. The more we pay in taxes, the more our lost opportunity cost is, right? So we have an opportunity cost on the money that could have been invested, but instead it had to go towards taxes. And then our deferred taxes, we didn't really have any deferred taxes here because we were paying them as we went, right? And then here on the flat tax, we have $105,000. And then when we do an immediate pay down, just moving the money in one shot, we've got a deferment of $247,000 in taxes, and then $168,000 if we did it over 20 years. And then of course our net result, what does this all boil down to? This is your net result down here at the bottom. And it looks like the immediate pay down would be the winner in this example, but there's other things to consider. What about the liquidity of the money? Maybe you had all this money in an account where it was easily accessible, and by getting some of these tax advantages, it required you to give up some of that control of the money, some of that liquidity. So it's not just as simple as looking at the numbers here. There's a lot of other factors involved as to whether or not this is the right decision for you and what your situation would look like. But now let's just take a look at the, not the deferred, but let's look at the tax favored in this example, okay? So tax favored accounts. As you can see, once again, we're still dealing with $1.3 million between the two accounts. But how much taxes did we pay out of our lifestyle along the way? You can see that in this immediate pay down, if we were to move the money right away into a tax-free situation, we would be obviously in a much better situation tax-wise. Same thing with the opportunity cost on the taxes and the deferred taxes. In this example, this is getting into some more product-specific situations, which my goal is to not get into much about products as we talk about these strategies, because that's going to be very specific to you. But in this particular immediate pay down example, you are minimizing a lot of taxes, but you're deferring them all until potentially at the end, unless, depending on the product that you get, there's ways to leave all this money tax-free at death. So using some life insurance, some other things like that. So there are some things to consider there if you do it correctly, and depending on your situation, this could be a 0. if you used a type of life insurance. But we can get into that in more detail if you want to have a one-on-one conversation. But for the most part, this has some pros and cons to it that you want to understand. Net result in this case, of course, would be a better situation, but there are other options as well that would be more of a tax deferral or moving it over 20 years or flatten it. There's a lot of different examples, but the point is that you want to do everything you can to minimize your taxes. All right, so in summary, if you have a taxable investment where interest is compounding, you have observed that compounding interest increases taxes. Leveling your taxes creates less wealth transfers, less holes in your bucket, right? Reducing the tax liability by repositioning principal and interest can potentially further lower wealth transfers based on the alternate investment results. But once again, please consult with a tax professional about specific tax advice. And if you have any specific questions for your numbers and you want to plug your numbers into something like this, then let's have a one-on-one conversation. You should have a link to the calendar here in your membership area. So thanks for watching. And this concludes our topic on taxes and how to reduce the taxes and the government's intervention and the government's involvement in your money, your savings, and your investments.